Hello, good afternoon, everyone, and welcome to the third in Fairer Finance's series of consumer duty webinars. As you know, a week today will be the first anniversary of the implementation of consumer duty, as well as the go live date for backbook products. It's a policy that's had an enormous impact in the last 12 months, in our opinion, and that's why we're going to be looking at it in detail today. How has consumer duty changed the way that firms interact with their customers? How has it impacted fees, charges, and existing business models? And where are things likely to go over the year ahead? I'm sure you've all read the updates that the FCA has put out over the last year, revealing where it's seen good and bad practice in its initial reviews of consumer duty activity. And as usual, these are very useful, but sometimes frustratingly vague. And that's where we hope to be able to fill in some of the gaps for you today. Rather than just talking about broad trends that we've seen in the market, we'll be providing you with some real life examples of good practice, as well as examples where firms may not have gone far enough. As well as supporting firms to review, rewrite and test their communications over the last year, we've also reviewed a number of fair value reports and helped firms gather the information that they need to compile their consumer duty board reports. Through all of those engagements, we've got a good understanding of the different approaches that firms are taking to meeting the consumer duty. And through the work that we do collating our ratings, we've also captured lots of evidence of the impact of this new policy directly from providers' websites and communications that we receive. We're all sort of hobbyists in this area. And if you follow us on LinkedIn, you'll see our micro observations on a regular basis about communications that we receive from financial services providers. As ever, I'm joined by my colleagues, Fairer Finance Director Tim Hogg and by Consultancy Manager Eve McGrady. In a moment, I'll be handing over to Tim and Eve to talk you through some of our observations from the last year, after which we'll move into Q&A. There's no need to wait until the end of the presentation to start filtering your questions through. Simply add them into the Q&A and we'll try and get through as many as we can in the second half of the hour. But for now, Eve and Tim, over to you.
So after the global financial crisis and following a series of mis-selling scandals such as PPI, policymakers and financial regulators such as the FSA and FCA, they looked to new tools that would help them regulate financial markets more effectively. And one of those new tools was behavioral economics, which later became known as behavioral science, incorporating a few of the more social sciences there, as well as economics and psychology. The consumer duty would be almost unthinkable without behavioral science. With behavioral science, more harm is foreseeable. People make predictable mistakes, to use the language of the FCA. Using behavioral science, we can help consumers make informed decisions. And behavioral science also highlights the importance of getting the right level of friction in customer journeys. So we're now going to draw out a couple of implications from behavioral science as these will help shape our views of what we've been seeing in the market over the last year. And the first one is that we are information foragers. We hunt for information in a similar way to animals foraging for food. We don't read every word, top to bottom, left to right. We rapidly scan communications for signals and clues about where the information is likely to be located. This, of course, means that good signaling is vital. A clear structure is very helpful, and we see that especially in our testing on vulnerable customers. Secondly, we scan things more quickly when reading on the screen as opposed to reading a hard copy, and our recall is less good online than it is offline. This means that positive friction is sometimes required to slow us down and to force us to engage. So for example, you can use layering or bite-sized chunks of information. In the context of our cognitive limitations, as we think of it, and our ways of thinking, our information foraging, for example, we tend to go for good enough rather than optimal when making decisions. We've only got scarce mental resources and we've only got a limited amount of time to devote to thinking about our insurance policy and our bank and our credit and so on. And this is really important because we face really difficult trade-offs with significant implications for us when choosing which products to buy and how to use those products. For example, we have to weigh risk versus reward. And of course, lots of biases and preferences come into this, such as loss aversion. We have to weigh up flexibility versus reward in a context where we find it very hard to predict our future needs. We have to weigh up the now versus the future and the short-term future versus the long-term future in a context where we have what we call present-focused preferences. For example, we tend to undersave for retirement and we tend to under-insure ourselves. In this context, we need as much help as we can in order to make well-informed decisions. We can't always stop people from making decisions which we think aren't in their best interests, but we can do a lot of practical things to help people make really good decisions, informed decisions that won't lead them to regretting what they decided to do. Eve, over to you.
Thank you, Tim. So let's take a look at the impact of the consumer duty so far. So where are we now, a year on from implementation? Well, it's fair to say that the most visible impact we've seen under the consumer duty has been under the customer understanding outcome. And it's not an overstatement to say that thousands of communications have been rewritten or created from scratch in response. We've also seen new communications and new technology invested in. So we've seen firms starting to send many more SMS to customers or using technology such as apps to communicate with their customers. In extreme cases where customers aren't getting fair value from their products, we've also seen examples of firms ringing up those individual customers. We do know that letters and emails can be missed and the bar is very high to make an informed decision, so perhaps firms do need to go further. Firms, of course, must be able to prove that their customers understand the features of the product and also evidence that customers have made an informed decision. And something we didn't necessarily expect at the outset is that as firms dig into the fair value question even more, we have found that it drives firms to strive for better customer understanding. So, for example, when faced with a decision such as removing a fee or communicating the fee better to customers, firms may want to opt for the latter from a commercial standpoint. So it's really about finding the evidence to show that customers are making an informed decision, and that's a key aspect of fair value. So that's our take on where the biggest impact has been. So let's now dive in and take a look at some specific examples. So what kinds of things have we seen? Well, firstly, changes to customer journeys. So providers have been finding new ways to communicate with their customers during those application stages. And one of those is videos. So Vanquis, Lloyds, HSBC have all invested in producing video guides for their websites. And these videos will pull out the key features of the products and perhaps help to explain some of the trickier terminology used. Some firms have even introduced mandatory videos as part of application journeys where customers can't progress in the journey without watching a series of short videos. And we've not seen as much of this in online journeys. It's still kind of burgeoning thing. We'd like to see more of it, and we'd like to see firms implementing this more. Of course, considering that you can't force customers to watch these videos, but at least if you make them short and engaging, there is a chance to communicate those key pieces of information in another channel that might be more engaging. Of course, it's not just journeys that have been improved, but documents too. So we've seen improvement in long form communications such as terms and conditions and policy documents. Many providers have been looking to rewrite and redesign their communications with good customer outcomes in mind. And this is just one example of a provider we've worked with to strengthen customer understanding. So firms are looking at reducing reading grades, changing design, all with the aim of making these documents much more accessible and making information easier to find. So like Tim mentioned, customers are information foragers. So creating that effective structure using language and design to pull out the key messages is really important and something we've seen firms doing more and more of. So some documents have been redesigned, but not rewritten. And improving design is definitely effective. It can help customers navigate documents, find key information, and of course make those super long documents much more engaging and less overwhelming for customers. But just addressing design alone won't be enough to ensure consumer understanding. So readability is still a key indicator of how accessible your document is to a broad range of consumers. So there is still work to do here to raise the bar for customer understanding so that all customers of all different backgrounds stand a chance of understanding their products and their policy documents. It's not just terms and conditions that have been addressed, but other types of communication too. So in pensions, wake-up packs that are sent to customers who are in the run-up to retirement have seen some overhauling. And we know of providers who are completely reconsidering their approach to retirement risk warnings, particularly in light of the consumer duty and, of course, the requirements for customer understanding. We often find in our conversations with clients that starting again from a blank page usually has the largest impact and can force the business to think radically when it comes to making changes in the best interests of customers. We've also seen firms addressing suitability reports and really reflecting on what information customers actually need to know at this point in the journey. So shorter communications have also come under scrutiny, of course, and many firms have done a lot of work to improve the prominence of key information and the prompts within those in those communications to customers. And we've seen some improved letters and emails out there. So we've got an example here. This is an email from First Direct. It prompts the customer to think about their savings options and consider potentially moving to an account with a better rate. But it could improve by providing information about the rates associated with these different accounts. It could also provide a much clearer, much more prominent call to action. Taking a look now at another example communication. So this one does show the rates associated with other possible accounts available to the customer. This is from a different provider. It also has quite an attention-grabbing subject line that clearly shows what the email is about, but it could still do better by showing the customer's current rate right now to enable them to easier compare against the other options. So it's all very well and good making these changes to communications, but there is now, of course, a greater focus on evidencing the impact of those changes on your consumers. So we've seen that customer testing has become much more part of business as usual, much more embedded in internal processes in light of the consumer duty. And firms are, of course, required to provide meaningful proof that customers can access and understand key information in their communications. In terms of testing outcomes, firms are now thinking about testing whether customers can then go on to make those informed decisions in their best interest off the back of the information they have. Firms are testing as well as focus groups and depth interviews. Firms are also rewriting documents, as we've seen, and getting these accredited to demonstrate both to customers and to the regulator that they are effective from readability and accessibility standpoint. As many of you know, we do accredit documents out there. We have our clear and simple mark for documents that meet our criteria, and also there are other firms out there who can accredit documents. So moving on now to think a little bit about some of the other outcomes of the duty, so particularly customer support. So how have firms been levelling up the support they offer to customers at key moments? Well, some providers are being very upfront about customer support, showing things like call wait times to set customer expectations from the get-go. And some of you might be familiar with this example on Coventry's webpage, where they show exactly how long customers might be expecting to wait to have their call answered. So, 25 seconds seems very reasonable time to wait to have your call answered, but what about, 30 minutes or 40 minutes? So really setting expectations in this way can, of course, help prevent those feelings of customer dissatisfaction and also avoid customers sitting on hold. And to be fair to Coventry, they were doing this before the consumer duty implementation, as well as showing their competitors' rates on their homepages. But what about providers not going far enough? Well, we have also seen that some providers are not doing enough in terms of being able to track complaints and levels of dissatisfaction and provide customers live updates about where they are in the system. So perhaps still more to do in customer support. So we have seen big changes to communications, as we've shown, and we are starting to see change in customer support. But what about changes to products themselves and to pricing? So let's take a minute to focus on some of the key changes we've noticed providers making in terms of fees and charges. Just to point out here that we do have a tool in our Insight portal where firms, where you can see our collated updates and any changes that firms have made in response to the duty, which we're consistently updating. And you'll find much more here than we can cover in today's presentation. But let's take a moment to talk about some of the key changes we have seen. So some examples of changes we've noticed providers making: firstly, cuts to fees, with foreign usage fees on bank accounts being cut. So things like Danske Bank and First Direct, removing them entirely. Monzo has also removed its fee on unarranged overdrafts. Virgin Money has axed its cheque cancellation fees. We've then seen interest on in-credit balances increase by some banks such as Starling. And of course, the FCA has let investment platforms know that it expects them to pay some interest on credit balances, and providers have been responding to this, so Trading 212, CMC and Hargreaves Lansdown. Barclays now offers interest on uninvested cash in investment accounts. Vanguard has removed its account fee on cash balances. In the subprime credit market, Vanquis has cut rates, and interest rates on premium finance have gone down, as well as gap insurance commissions being cut. And that's just a flavour of some of the things we've seen over the last 12 months. So providers have been making significant changes in response to the duty, as we've seen, but where might the regulator look next in terms of price and value? Well, sectors with substantial cross-subsidies will certainly be one area, and the FCA may look at credit cards and current accounts here. They will be asking, are there pockets of customers who are getting poor outcomes paying for those who experience good outcomes? With current accounts, we're thinking about in-credit interest specifically, so there may be some firms who have cut fees related to their current accounts instead of paying interest on credit balances. Firms will really have to quantify and justify any of those cross-subsidies that exist. We may then see the regulator focus on price comparison markets following the introduction of GIP, which has generated brand stacking in sectors such as motor. Funeral plans may also come under scrutiny given there is no regional pricing. In equity release, some providers are still offering the option to take a gilt-based ERC, so customer understanding of this form of ERC may be challenging to evidence. Also, the regulator may question whether providers are doing enough to signpost alternatives to equity release. As for investments, we may see firms considering more useful risk warnings. So we know that for many customers, the risk warning capital at risk does not do much. Motor insurance and the poverty premium is likely to be an area of ongoing focus, given this is a mandatory insurance. And FX fees and clarity around markups may face scrutiny too. So now let's take a look at some final thoughts before we wrap up and move into our discussion. So some key takeaways here. As we said at the start of the presentation, we have seen the most change in customer understanding. So if you have not reviewed and improved at least some of your most important communications, it's safe to say that you're probably not going far enough. Firms need to think big and make radical changes to improve transparency. As we've touched on, testing should become part of business as usual if it's not already, and really being embedded into your internal processes. As for price and value, where your products are not competitive, are you considering making changes to your fees and charges? And if not, are you letting customers know that there may be better deals out there so they can go on to make those informed decisions? A final thought is that if implementing the consumer duty is not feeling a little bit uncomfortable, then perhaps you're not doing it right. So I'll now hand back over to James to conclude. Thanks.
Brilliant. Thanks so much, Eve. Good. Well, hopefully some food for thought there, and some of those things will be familiar to you, things that you'll be doing in your own organisations, perhaps other areas where gives you some ideas where there might be room for improvement. As I mentioned earlier, we're going to move into a discussion format now, and we're keen to hear any questions that you might have. So please do just type them into the Q&A or chat boxes, and we'll try and get through as many as we can. Eve's going to share the discussion. So Eve, over to you.
Thank you very much, James. So yeah, as James says, please do start leaving your questions in the Q&A. I've got a couple of questions that I prepared earlier to get us going, and then we'll move into some of the ones that have been sent in. So the first question I had, Tim and I laid out some of the changes we've spotted over the past year. And of course, that was only a small snapshot of what's been going on. But do you think, James, that there are any areas where we've not seen enough progress with Consumer Duty yet?
Yeah, I mean, I think that some of the smaller firms and some of those markets that are a bit more fragmented, so I think particularly IFAs, for example, probably there hasn't been an enormous amount of work and activity in response to Consumer Duty. I mean, specifically in that sector, I think it's still quite hard to get an idea of what you're going to be charged if you're thinking of approaching a financial advisor, and and obviously, the regulatory burden, can be significant if you're a very small firm and you take Consumer Duty at face value. But I think, in terms of the big firms, there is activity going on. The question is whether or not firms are going far enough. You highlighted a couple of examples there of people who have rewritten policy documents or had a go, but actually, sort of when you drill down into it, you see that really this is a redesign and not much more in terms of language. And, as we've alluded to, if you take this at fair value, especially if you're a sort of reasonably sizable firm, it creates an enormous amount of work, and you can't bite that all off overnight. And we know that, in some cases, firms are still working on publishing new T's and C's or policy documents, and we're not going to, see the final versions of those out in the market, perhaps even until 2025. And if you've got thousands of letters and communications, it may take you 2 or 3 years to get through all of those and get them in exactly the right place. It may seem sort of counterintuitive, but letters are often a little harder to rewrite than just, the nuts and bolts of putting new words on the page. Often there are limitations in terms of systems and how those letters are printed and distributed that make it harder than it should be to make it what should be simple changes. And so, many firms are still working through some of those operational considerations. I think the other thing, is really just in terms of fair value, particularly in the insurance sector. I think firms are realizing that perhaps their first attempts didn't go far enough. Certainly, and not just in insurance, but I think particularly in insurance, because fair value became a requirement before Consumer Duty. There hasn't been enough drilling down into the value that individual cohorts of consumers are getting. There's been a lot of looking at fair value at an aggregate level. But of course, it's not really okay in a Consumer Duty world to say, well, most of our customers are getting a great deal. Yes, we know that these guys over here are getting a pretty bad one, but that's fine because that's offset by these guys who are getting a fantastic deal. Actually, Consumer Duty asks you to work to deliver good outcomes for your customers. And if that kind of breaks the model, then of course, you're going to have to be thinking about the model.
Absolutely. Thank you, James. And actually, maybe building on that a bit, Tim, perhaps we could speak a bit about, that point we made around cross subsidies. So the Consumer Duty doesn't seem to have disrupted any core business models in the banking sector, which rely on those cross subsidies. So do you think that's something we're likely to see over the year ahead?
Well, the first thing to say is that cross subsidies are obviously inherent in many existing business models, including some of them in retail banking, and that cross subsidies are not necessarily inherently bad for customers, but they can be a signal that the business model is systematically delivering poor outcomes for a particular group of customers. So if you think about the whole distribution of outcomes, have we analysed the whole distribution? Are there people who are getting a poor outcome? And a cross subsidy is sort of an amber flag that there might be something there to look into. Although when you look into it, you might realise that after quantifying the cross subsidy, actually you're very comfortable with it and you think it is delivering good outcomes. We always say follow the money, find out who your most profitable customers are and why. And if your most profitable customers are still getting great outcomes, then it's probably okay. I guess over the last year, we've seen more emphasis on quantifying cross subsidies from firms that haven't previously done so. And we think there's probably still some more room to go on that. It's partly been driven by the FCA and partly driven by and sort of indirect regulation where boards are wanting to get to the heart of what the consumer duty implications are for their business models, and understanding cross subsidies is sort of a really important part of that. So even if the FCA hasn't asked you a direct question on cross subsidies, we've seen lots of firms going around and quantifying them.
Thank you, Tim. And James, perhaps we can reflect a bit on, the current situation we're in. So a new Labour government was elected 3 weeks ago. What impact do you think that's going to have on the financial services market?
Yeah, I mean, I think that, obviously traditionally people were being scared of a change in government, particularly a change from Conservatives to Labour. There's been that perception that, perhaps there's going to be a less business friendly government. But I think, political followers will have seen that this Labour government has been going out of its way, both in the run up to getting elected and post election, to show that it is a business friendly government. And financial services is one of our biggest industries. And, if we're going to find some way to deliver growth, then we're going to have to protect it and foster it. So, I think we're going to see a bit of a hybrid, of both using the consumer duty to carve up some of the existing rules. So, and, actually a bit of a reduction in regulation, which is not what you would necessarily expect from a Labour government, and perhaps a rolling out of consumer duty to other sectors. And I think there's no reason why we couldn't see it being used in other consumer markets like energy and broadband and rails and so on. I think it works really well. But I think we will see them be proactive in areas where there are market failures and problems. We already have sort of had an inkling that motor insurance is likely to be one of the first consumer issues that they get stuck into. It's become very expensive. It's mandatory. There are people in the country who rely on it and have to buy it. So, we're going to have to find ways of supporting people if we want to be able to keep them on the roads when they rely on their car and have no other alternative. And that may open up a whole can of worms, because I think once you start to peel away some of the things that are driving high prices and how you start to unpick that, you quite quickly start to ask quite difficult questions of the whole business model, and what goes into the pricing. How is the taxation working? So we're going to need to consider all of that, and it could be a big moment for the insurance industry. But I don't think that financial services needs to be scared of Labour government. I think hopefully, it seems like sensible grown-up government, and something that, a great opportunity for us to try and get some of those issues on the table that up until now, there hasn't really been anybody listening. It hasn't been, I get the impression that this new government wants to hear what the concerns are and try and get stuck into them where it's possible. And if it's not going to cost millions of pounds to fix them, then that obviously increases the chance that they're going to take a stab at it.
And in terms of enforcement from the FCA, how long do you think it will be before we see some enforcement activity off the back of the new rules, James?
I mean, I think on that front, probably be some time. I mean, we may see them use consumer duty at the edges, like thinking on a very small firm or a particularly niche issue. But I think on a big scale, like thinking about big banks or insurers, that's reasonably unlikely. If you look at the way the FCA has moved over the last year, it strikes me that's likely to be the sort of playbook for the foreseeable future, which is, every now and again come to the market and let people know where it's seeing good practice, where it's seeing firms not going far enough, a few deep dives on a sector by sector basis. Gap insurance has obviously become the sort of poster child for how things might evolve. There was a warning there about fair value. The industry didn't respond quickly enough. And then the FCA kind of dived in there and shut the industry down for a few weeks and asked them to kind of fix things. So, I don't think there's any reason why we won't see them to continue with that. But obviously, they're going to move sector by sector, theme by theme, follow up with Dear CEO letters. And I think it's really going to be, where they feel that firms are, massively in breach of that and ignoring that, where they start to turn to regulation of this. But we are already starting to see it come through in ombudsman decisions as a factor at play. And I know that, a complaints review and how firms are tracking complaints and the trends they're seeing in complaints and following up with them is on the radar for the second half of the year. There's going to be a customer support review in the second half of the year. How are firms dealing with that? So those are the areas where I think we're going to see the FCA most active over the next year. Maybe it's year 3 or beyond before we start to see actual enforcement cases. And of course, bear in mind, enforcement takes forever. Whenever you do actually hear a final notice, it tends to be about something that happened 5 years ago or something. So who knows? Maybe the first enforcement case is underway, but we won't hear about it until 2030.
Thanks, James. And Tim, a question for you. So something we hear the FCA talk about a lot is friction in customer journeys. We didn't have time to talk about that today, but what have we seen over the last 12 months in terms of firms being able to assess the level of friction in their journeys and addressing any areas where there might be unnecessary friction or sludge?
Yeah, so we have seen providers starting to really analyse the level of friction in customer journeys. Actually, this relates to a question we've had regarding claims and insurance as well. Currently, a lot of the focus has been on exit friction, which is the friction that you go through when you're leaving a provider or switching away. And the focus starts there because there's an obvious impact on the level of competition in the market. If switching is harder, fewer people will switch. And that's the sort of thing that gets economists at the FCA and elsewhere very exercised. And we've seen examples of that working out in GI and cash savings. I recently opted out of my auto renewal or my car insurance and found it a very interesting experience. We've also seen scenarios where insurers have gone through the claims process, looking at exactly what is required and the level of friction in that journey and the level of delay in that journey, and trying to take out the excessive friction here. Now, obviously, there is a commercial side to this as well, because a more efficient process can save costs as well. But it typically hasn't been high up on the agenda. So I think we will probably see a bit more focus there. The flip side is there are scenarios where there can be insufficient friction. We've seen examples of where consumer intentions probably haven't been tested enough. And this can often occur in markets such as consumer credit. So you can think of consumer behaviors which end up incurring extra fees and charges or incur more costly ways of borrowing than necessary. And you think, well, maybe a bit more friction in that journey might have been helpful to deliver really good outcomes. Ultimately, getting the wrong level of friction is what we would call a deceptive pattern or a dark pattern, using our behavioral science frameworks.
Thank you, Tim. And perhaps we can now move out to some questions we've had from the audience. So the first one being, we did mention the next markets which the regulator may explore would include travel insurance. We didn't add any detail on that. So James, I don't know if you'd like to speak a bit on travel insurance.
Yeah, I mean, you may have seen the stories in the trade press over the last week or so about the number of ombudsman complaints in the travel insurance sector kind of hitting sort of new near-time highs. And, my view is that the problems in the travel insurance market were seeded well before the pandemic. We obviously saw, a massive fall away in the number of complaints because the number of policies in force dropped as people weren't traveling during the pandemic. But now we're sort of back to business as usual. We're back to the same old problems, which is these are cheap products. They're very complicated. People buy them quickly, they don't understand them, and then they get that kind of shock at claim stage. And of course, it's worth remembering that the consequences of, travel insurer acting poorly can be as serious as, somebody dying. And, at the edges, there have been examples of that. So I think this is a sector that hasn't really had a lot of attention on it for a while. Just like all other parts of insurance, it's suffering from hollowing out. People are buying these through comparison sites, and so to stay at the top of the comparison tables, insurers are sort of chopping out elements of cover, and most people have no idea exactly what is covered, what isn't covered, what the limitations of these policies are. Favorite examples of mine, that still exist in the market. Some policies won't cover you for enough to fly your body home if you die abroad. Nobody is running around looking for that kind of cover, but they assume it's there. On the more mainstream basis, obviously most of these policies don't want to pay for you to go to a private hospital. And, people often are totally unaware whether a hospital is private or public, particularly if they're in an emergency and they end up having to be transferred or denied care at a particular hospital. There's rising excesses. So I think a lot of problems in this market, and responsible insurers hopefully will welcome some scrutiny there so that we can kind of raise standards there.
Thanks, James, and thanks, Sharon, for your question. We have one from Owen here who says, we've all seen a shift by banks and insurers as a result of Consumer Duty, but there are still times when the regulators have intervened or expressed opinion, gap insurance as an example, and investment cash pot interest. Tim, I wonder if you'd like to come in on this.
Yeah, I think there's probably still going to be room for the FCA to come in on particular issues. I guess the real question is, how do we predict which issues are the FCA going to come in on? How do we mitigate the potential consumer harm before it requires a regulatory intervention? I think it all comes down to what is foreseeable and the foreseeable harm. If you go back half a decade, some of these outcomes were just seen as normal outcomes from a competitive market, perhaps. But that's no longer a sufficient narrative to justify outcomes. And actually, when we look at stuff and you step back, you try to forget everything that you've learned about from working in insurance for decades or whatever, and you look at the outcomes that are generated from that consumer perspective, you think, hang on, this probably is foreseeable. We did know, behavioral economics tells us that some people are going to behave this way. I think wherever you have that sort of obvious foreseeable harm that everyone's just ignoring a little bit, that's probably where we're likely to see Dear CEO letters. I don't know whether, James, you have any adds to that?
I was just going to add, gap insurance, I think, was entirely predictable. If you look at the FCA value measures work that they were doing over the last few years, that was highlighting areas where there were sort of very low claims ratios in sectors. I think the stat in gap insurance was less than 10% of premiums being paid out in claims. That's not to say that nobody's getting good value, but obviously it depends on the size of the premiums and the cost of marketing and distribution, all the rest of it. But if you're in those sectors where the sort of high level markers are asking challenging questions, then you're likely to be nearer the top of the list that the FCA is coming to next, in my opinion. I mean, we talked a little bit about cross subsidies earlier. Again, I think that credit cards, current accounts are up for some scrutiny there. We've gone from a world where nobody pays credit interest on current accounts when interest rates were zero to a world where almost nobody pays credit interest on current accounts when interest rates are at 5.25%, and all of that value is passed straight to the shareholder. I'm not sure that will necessarily be allowed to prevail. I'm sure banks are very happy they didn't have to do their fair value assessments 3 years ago.
Thanks both. We have another question here about kind of consumer complaints and consumer whistleblowing. So Charlotte says there currently isn't a consumer whistleblower route to complain directly about a company to the FCA. Do you think they might move to bring in the equivalent of what the ICO offer, allowing people to report GDPR breaches? James, I'll come to you on that one again.
I think it would be good to have an easier way to raise concerns and have some confidence. The problem is that the volume of consumers is so much greater. If somebody's working in a firm, they're likely to have an inside track, and it's absolutely right that there are easy ways to get yourself heard as a whistleblower. As a consumer, with the greatest respect to someone who's been sort of taking letters and emails from consumers for the last 25 years, there's a lot of people out there who think that they've been served a terrible injustice when perhaps they haven't, they've misunderstood the nature of the product. And so it just makes it hard to cut through all the noise with that. But, I do think that it's right that, people have easy ways to raise their concerns and have them heard. And hopefully the FCA is looking at the trends that are coming through the Ombudsman. They do still allow consumers to make complaints to them, and hopefully they are analysing those trends. And all of that is what eventually drives the FCA's next line of focus. So whether or not we need a consumer whistleblowing process, I'm not sure. I'm not sure what isn't there at the moment that would solve, because in the end you still already have the Ombudsman to go to for complaints. But yeah, those are my off the top of my head thoughts.
Thanks. And we have a specific question here about equity release from Jason. So Tim, perhaps I'll shift this one to you. So he says, gilt-based ERCs versus fixed-rate ERCs. How do we justify fixed-rate ERCs, which rely on cross-subsidy to operate? Customers could redeem with a fixed ERC when the lenders actually suffered no loss to reinvest. Gilt-based ERCs are fairer.
Well, I mean, this is a really interesting debate, right? And what I'd say is that a cross-subsidy is not necessarily a bad thing, right? So cross-subsidies can be really good. And let's get into this one. So ultimately, it comes down to whether a customer can make an informed decision on whether to take a fixed ERC or a gilt-based ERC. Now, of course, gilt is a risk. The customer takes a financial risk with that one. Do people actually understand that risk when they take it? I mean, maybe if you've worked in the city as a trader for decades, you might understand it. But our experience of working on this product is that most equity release customers don't understand it, even with help from advisors. Given that many people struggle with compound interest, the idea of getting gilt-based ERCs across is obviously a bit of a stretch. That sort of leads us into a discussion of, if many people aren't going to understand it, maybe the right solution is, instead of trying harder and harder and harder to communicate the product and probably fail, maybe redesign the product. Or you could introduce different levels of friction so that different people are able to purchase the more complicated product. With trading, for example, for particularly complex or risky trading products, only very sophisticated customers are allowed to purchase them. So that's also another option.
Any thoughts you wanted to add on that one, James?
No, I mean, I agree with Tim. And I think it's about, gilt-based ERCs were designed first and foremost to protect the firm, and they give them that certainty that if gilt markets move against them, they're able to pass that cost on to the customer. But if you start with the customer has no idea if they're going to need to redeem their mortgage. Life circumstances change, and people can't foresee that. And so, sure, the gilt markets may move in their favour and they end up with no early repayment charge, which is obviously a great outcome for them. But it could go the other way, and then they get penalised. And I think, really, in all other markets, providers sort of price in the cost of that risk in different ways to themselves. So, there are still ways to protect themselves, but not in a way that basically says, if markets go the wrong way, we're going to land all of that cost on you, which is the way gilt-based ERCs work. I can't think of any other market that works in that way. And as Tim said, it's very difficult to understand as a consumer. So, I think that is one. It is already something that we're starting to see disappear from the market. But for those people in that industry who have turned up to the Equity Release Council conference, they heard me banging on about it for years. So happy to give anybody chapter and verse on that another time.
Excellent. And we have a bit more of a general one here on FCA and consumer advocate views. James, again, perhaps I could take this one. So Rupert says, do you feel that FCA view on progress so far is positive, and where do you expect them to go from here? And overall, is feedback from customers and customer advocates that overall customer outcomes are being improved by the consumer duty?
I mean, I think the FCA has been very happy with the way things have gone over the last 12 months. Perhaps the bit that not everybody sees, that we've been lucky to see a little from behind the scenes, is that this isn't just another policy that the FCA is implementing. It is also generating enormous cultural change within the FCA. Consumer duty is now at the heart of all kind of retail conduct regulation in the FCA. And that's been a massive change for them. But, if you look at what we've talked about today in our presentation, this is just in 1 year. We can talk to dozens of things that have changed. I mean, thousands of communications that have changed. I mean, I think there was a piece of research out today saying, most consumers say they've seen no impact of consumer duty at all. But, I don't think they're the right people to ask. I mean, especially not after 1 year, because, if you've seen a couple of letters that you don't normally even read get a little bit clearer than they were last year, you might not have noticed that. But for those of us who were spending our time observing the market, it is undeniably having a positive impact. It is forcing companies to think about those foreseeable harms and how they prevent them. And the whole nature of kind of how firms approach conduct risk has changed over the last 12 months. I can't think of any time in the last 25 years that I've been in this industry where there's been anything as significant as this, apart from perhaps when the FSA came into being, it's just in 2001. And this is day one. I mean, the great thing about consumer duty is that it has the potential to be a ratchet, that we're all at the moment, everyone's scrabbling around trying to get their letters and communications in a nice order and do the kind of basics. But if you think forward to, when all of that is done, then we can get into, well, actually, what is good enough in terms of communication? Sure, you've all had a go at writing your communications, but actually, here are some really good ones and here are some terrible ones. And what are the right ways to communicate information? And, let's get into some of those existential problems that we've talked about in terms of cross subsidies. And over time, we can really just start to raise the bar of conduct. And, for me, the beauty of it is it finally aligns the interests of customers and shareholders, which was always the real problem. And that because financial services is complex, it was easy for firms to make the most money by doing things that weren't often in their customers' interests, and often they wouldn't understand that. Whereas now you have to work in your customers' interests. And actually, if you do that, in the long run, it will be better for you anyway. It's just that nobody ever wanted to make that shift because it costs a lot of money in the short run to achieve those long-term gains. But the long-term gains will be realised by everyone. Higher rates of retention, better levels of trust and confidence in the industry, and hopefully then a bigger pie, because everybody at a consumer level has got greater levels of trust and values the products that are in this market.
I mean, just to add to that, we've seen cases where providers have done consumer testing, which they wouldn't have done before. And the outcome of that testing, somewhat predictably, has been that they should make the costs more transparent. And the outcome of making the costs more transparent has been that the providers have achieved greater levels of trust with their customers. And so you sort of think, well, I can understand why maybe costs weren't transparent before, because there's maybe a commercial impression that maybe if you make the costs really salient and transparent, people will switch away. But a lot of behavioral research shows that making the costs salient and transparent increases trust as well. So that's a good example of where there wasn't actually as much of attention as we maybe thought previously.
Thank you both. And I can see that Chris has posted in the chat the survey that James referenced, in case anyone is interested at looking at that. A question here about marketing, which I'll direct to you, Tim. Sarah's posted, do you foresee any challenges or actually benefits with firms using third parties or agencies to support their marketing strategies, for example, affiliate marketing channels?
I guess the more that we adopt best practice in terms of making sure that customers are making informed decisions, the better, right? So if working with third parties can mean that you can, really use that best practice in terms of how to communicate a cost effectively, how to communicate a benefit effectively, while staying compliant with fin problems and all that stuff as well, if you can really leverage that best practice, then that's fantastic. I guess when thinking about affiliate channels, there's a really interesting question here, going back again to the distribution of outcomes. And this is one for monitoring and making sure that you're monitoring the different outcomes that people have when they come to you through different channels. So for example, you might get some customers through a price comparison website, you might get some customers who come direct, other channels, direct mail, whatever. Monitor those outcomes, see how people behave differently, for the different channels that they arrived. And actually, you might find some quite interesting nuggets, which could highlight that maybe some channels are better at communicating some of the benefits or costs of the product or limitations or risks than other channels. And I think that's what the FCA will expect, actually. So in your MI, really do make sure you've got the ability to monitor behavior by channel. And sometimes that might involve slightly changing how you operate that distribution chain, making sure the data is flowing up and down it. But we've seen good practice there.
Thanks, Tim. And another one for James here about claims. So Emma asks, you've spoken a lot about point of sale communications, which was critical of general insurance claims handling this week. What action do you expect the FCA to take in this area?
Yeah, I mean, obviously claims is that sort of layer underneath the surface, isn't it? Where, it's not instantly obvious what the impact of Consumer Duty has been on that. I mean, obviously, we've been working in some of these firms and have got to see that there is a lot of work going on there. But we've also, been involved with firms where there isn't a good enough analysis of the things that are going wrong at the claim stage. There's not a good enough feedback loop and process built in to ensure that they're learning from that. And then we talked about travel insurance earlier and that rise in complaints. So, of course, when it comes to insurance, there's nothing more important than claims. That is the moment of truth. I think in a lot of firms, there is a lot of work to do there. Firstly, just to make that administrative process smoother. Still there's too much paper involved in a lot of claims, which, I think in the worst cases is deliberate sludge in the process. People should be able to track the progress of their claims, understand, where they are, what's happening next, when they're going to hear the next result, when they're going to get their money. And I think because, it's always been a minority of people that have claimed in most GI markets. I mean, pet is perhaps an exception there. I think it's always been a place that sort of hasn't been as well invested in as it could be, because customers aren't banging down the door going, I really want to see that you've got a digital slick claims process. But of course, Consumer Duty very much asks you to get on top of that. And I'm sure it'll be a theme that comes out as part of the customer support review that the FCA is doing in the second half of this year. There's going to be a lot more focus on those trends that are coming through in terms of ombudsman complaints to work out what is driving the problems in that market. And, I know the insurance industry is up for this challenge. They do see the prize here, which is to get to a point where people really trust them and value insurance. So, hopefully they'll embrace this challenge and get to grips with some of it.
Thanks, James. And one for Tim here about data. So Steve says, you mentioned burden. Product sales data requests from the FCA seem like overkill in terms of standard data gathering. I could understand them more if PSD was gathered as part of an investigation into a specific firm. What are your thoughts on this?
I think we're going to have to get used to the regulator asking for more data as part of business as usual. That's sort of quite explicitly part of their strategy and their business plan. So I don't think that's going away. We're also seeing the regulator look into efficient ways of gathering data across the market. And I think part of that comes into benchmarking. So if you want to sort of see what the regulator is going to think when you send in your request, send in your responses to these requests, do your best also to look at how you benchmark to others using publicly available information. You can get quite far doing that sort of thing.
Thank you, Tim. So entering the final few minutes of our session today. So one final question, which maybe both of you can give some concluding thoughts on, from Jessica. Which one change from a provider have you seen that you think has done the best and that's had the most positive impact for consumers? I'll let Tim jump in first on this one.
We've seen loads, and lots of it can't be shared immediately here, but you can see publicly available and you'll be receiving those communications. I want to go really niche with my answer to this, which is we've seen communications be redesigned for particular types of vulnerable customers. Doing really in-depth interviews, one-to-one interviews with vulnerable customers, finding out exactly how they view the communication, how they read information, and then redesigning the communication completely as a result. And actually that is so informative and so impactful. It will only impact a small group of people, but actually when that starts to get rolled out across the sector, it will be massively helpful for those people. And it will help us all, because ultimately better communications is better communications for everyone.
Thanks, Tim. Over to you, James.
Yeah, I mean, gosh, in terms of one single thing, I find it very hard as well, because there's been so many different examples. One of the examples I used a lot that I'll probably misquote now the exact stat, but I loved it, and this was from a presentation I heard sometime at the end of last year, was Atlanta Group, the insurer, talking about sending out something like 3,000 more text messages a week or a month. That kind of stuff, which we could have done that before. Anyone could have done that, but Consumer Duty made them go, of course, we know our customers don't read a lot of these letters and emails we're sending. We need to try harder. We want to try harder. We're going to now do other forms of communication. All of the letters and rewrites that we've seen, are making an enormous difference. And there's nothing like a hit to the bottom line, I guess, to sort of, to be impressed in terms of the impact. I mean, people like First Direct and Santander and Danske Bank getting rid of their foreign usage fees on their bank accounts, those things to me are very clearly a nod to fair value, and how do we prove we're offering fair value in the current account space, or getting rid of ancillary fees, or cutting commissions. That all of those examples are really positive. And as I've already said, I think there's a long way to go. There's much more that needs to change and can change. But if I was going to give a shout out to one organisation, I think I've been incredibly impressed by Nationwide. As a big organisation, they are now basically sitting kind of at the top of almost all of our tables. And massive uplifts in sort of transparency and performance at the Ombudsman. And it's very hard to do that on a large scale. So I've been really impressed by them.
Brilliant, thank you. And thank you everybody for leaving your questions. I think that's about all we have time for. So yeah, back over to James to wrap up.
Yeah, brilliant. Well, look, thanks very much. I hope you've all got something out of that. I'm sorry if we didn't have time to answer your question. But we'll be back. We'll be back in the autumn for our 4th Consumer Duty webinar. Over the course of the last few months of the year, we'll definitely be doing a session on customer support once we've seen the outcome of the FCA's customer support review. We're also going to be doing a deep dive into complaints, following up on the FCA's complaints work that it's doing as well. But until then, have a fantastic summer. If we can help you out at all with anything, do get in touch. But bye for now.